we've seen the biggest K-shaped distribution of wealth and economy and bifurcated economy of the last 5 years of any that I've seen in my lifetime. I think the top 20% of people are driving all the spending. They have the money. The bottom 80% of people, all they have is the higher grocery bills. June of 2021, CPI data was already printing over 5%. The housing market was inarguably on fire. And what did the Fed do? They hit the gas. I think in 20 years, if you ask me about the J. Powell Fed, I will say it was basically a failure. I don't take no pleasure in that.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman. I'm the EdJR mining guy over on X, and of course, you're a host of this channel. And I'm looking forward to bringing back Jim Iuorio. We've had him on numerous times here on the program, but it's been a while. And it's time to get an update. And he's the contributor of the Unfiltered Investor newsletter, and I'm really looking forward to catching up with him. We just had the FOMC meeting the last couple of days here, and we got a decision out of from the Fed chair. I really want to get Jim's take on it. What does he think? Now we're talking 2 rate cuts again, and we got to talk about the data that the Fed is relying on and what his thoughts are on that data, whether it's accurate to use them or is the right thing to do, and what would Jim do? You know, maybe that is the overlying theme here of this conversation here. But before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously to grow this channel and bring fantastic guests like Jim on this program. So thanks so much for doing that. Now, Jim, it is great to welcome you back on the program. Really appreciate you joining us.
Thank you so much, Kai. It's always fun to be here.
Yeah, really looking forward to this. We already had a couple good laughs before hitting the record button, so I hope this continues during our conversation, Jim. Maybe we'll start with a bit of a basic question, but maybe how vulnerable is the U.S. financial system right now as of today?
Okay, so the question, how I gauge this, the answer to this question is demand at auctions for treasuries, particularly longer term. So there have been some hiccups over the last, call it, year and a half, where we have had some very poor auctions, meaning the demand wasn't great, which, by the way, at these high levels of interest rate, you'd think that global demand would be pretty good. So I'm watching that, and that's where I'm viewing cracks. That being said, every time I think there's cracks and I start to panic a little bit, then the next auction has pretty good subscribers and does pretty well. So I think that's where I'm looking for. So how vulnerable is overall? I say right now, not very, because again, everything bad that we're doing, I think the weak dollar policies of the last several years have been replicated in all the other countries as well. So I think in some ways it's a currency race to the bottom. But I think our financial system right now is sound and things are good. But I will be watching the every bond auction that goes up further, particularly longer end, to see if the demand is still there. And right now it's okay.
Where did you see the initial weakness there, Jim? Was it more on the long end, short end?
Yeah.
Where did you see that?
Started about 2 years ago. I might be getting my numbers wrong a little bit. And I believe it was a 7-year auction that went poorly. But the poor demand auctions, there's been probably about 4 or 5 of them in the last 18 months. And they generally are 7 years and out. There was a 20-year that went poorly a couple of weeks ago. Man, I think that was actually maybe in March. But there was a 20-year that went poorly. So again, I'm looking for the foreign demand. And foreign demand for U.S. Treasuries has been okay. It's shifted quite a bit. You know, China used to be one of the bigger buyers, and they are not one of the bigger buyers anymore. We talked about something before we went on, is that in 2000, 71% of global foreign reserves were held in U.S. dollars and U.S. Treasuries. That number's been trending lower, down to a low of around 57% now. Now, there's some things that have accelerated that, which have been a very big beneficiary. I mean, gold has been a very big beneficiary, particularly in the last 5 or 6 years, to that trend.
Yeah, no, gold has absolutely picked up the slack in the last couple of years here tremendously. We'll get to that and
Sure.
the role of gold overall, but I want to stay on the bond sales, the demand as well, because Andy Schachman brought it up to me actually, and I know you spoke to him recently as well. But he pointed me towards SOMA. That's the Fed's system of buying bonds and bills and jumping into the auctions. How closely are you following that, and do you see anything out of the normal there?
So the Fed buying bonds this has been one of my base cases, and I know I've been saying I'm long gold and really long gold for the last 4 years, and there's some reasons for it. So the Fed is right now in quantitative tightening, meaning they're letting bonds roll off, which is the equivalent of selling bonds. They've slowed down their selling of bonds when some of those bond auctions went bad. I think they are prepared to step in and start buying bonds again. Now, they did buy bonds when Silicon Valley Bank collapsed was that a year and a half ago and they did open up a window and bought all the debt from them, and the Fed balance sheet went higher. But my base case is that there will come a time, just because of how many bonds we have to sell. We have to roll over $9 trillion of debt just this year, and the amount of long end we have to sell, because we've been selling for the short end of the yield curve for several years, because that's where I believe Janet Yellen thought it was safe, and she didn't want to wade into the waters of longer term. But at some point in time, we have to sell longer term bonds as well. But anyway, so when that happens, I think there is a chance that the Fed, more than a chance, that the Fed comes back in and starts buying bonds again. If that happens, then I think that we will see it in the dollar, and we will see it in my whole, poor stewardship of the dollar portfolio, which is gold, silver, platinum. It's going to be palladium at some point too, but I'm waiting for some marks. Real estate, Bitcoin. These are all things I've been holding for years because of it. And this is a vote of mistrust for our financials. I know I just said our financial system is not on any sort of precipitous point of falling over. I don't believe that, but I believe it could be a long, slow slog of mistrust.
Give me 60 seconds and I'll show you why you should be buying silver and how to get started. Continuing price spikes in groceries, healthcare, and housing tell the story of inflation, and almost everyone is seeing their dollar purchase less every year. As the reality of inflation sinks in, investors are acting to diversify and protect themselves, their families, and their savings. That's why Money Metals is offering a silver starter kit to help you get started in holding tangible wealth. This mix of our most recommended forms of silver includes 9 silver coins, totaling 4 troy ounces of pure silver. These silver coins are popular and widely recognized, making them easy to sell back for cash too. Low transaction costs and transparent pricing are among the reasons Investopedia calls Money Metals the best precious metals dealer in America. Don't waste any more time. Start protecting your savings today with physical silver at moneymetals.com/go.
Yeah, let's expand on that, Jim. Because
Sure.
it sends a massive signal when the Fed starts buying back bonds. That's monetizing debt, essentially. Yeah. That's the term. What is the signal then to the economy overall? Like, what is it sending? You already hinted at, of course, lower U.S. dollar, higher gold, and other precious metals, for example. But let's break that down even a bit more. Like, what does that mean for the economy?
So it's a bad thing for the economy, because it certainly could reignite inflation. They have choices, and none of them are good. They'll have choices to come in and support the bond market. If they do that, they could easily reignite inflation. That's a problem. So, and this whole thing depends on government spending. Is the new administration willing to cut spending? So far, the market is not confident that they are. There was a lot of big promises about what we're going to cut. But so when you're talking about cutting 10, 20, $100 billion out of the budget, that's nothing. That's throwing a deck chair off the Titanic. They haven't done anything substantive yet. Until we see real live austerity like we saw in Argentina, which, by the way, that has an economic ramification that's very, very negative as well. So there are things on the horizon that are lining up that could be bad, and none of the solutions can fix all. As Thomas Sowell says, there are no solutions, there are only trade-offs. So they'll say, okay, can the government stop this rampant spending like drunken sailors? Well, they can slow it down a little bit, and then that could affect the economy. Then the Fed may have to lower rates. If they keep spending at the level they are, then they have a crap ton more bonds they have to sell to finance that spending. Will the Fed come in and buy those bonds if nobody else wants them at the rate we want? That's the possibility I think is the most. So no matter what, things could be rocky for the next couple of years as we transition from different financial systems. Did any of that make sense, or is it too convoluted? It's like I'm making the stew here. There's different ingredients.
No, it's a complex topic in general, but I think you made perfect sense there, Jim. And maybe I have one last follow-up on the Fed balance sheet. Like, how strong is it? Can it even absorb more of those shocks, let's call them? Can it absorb more of the debt that has to be issued? You were talking about $9 trillion having to be rolled over.
Yeah, sure. It can buy 50 trillion of it, but there is huge ramifications of it. Remember, the Fed has the ability to essentially, despite the fact that Jay Powell kind of denied this on 60 Minutes, they print money and buy bonds with it. And they increase the M2 money supply. It's inflationary. It weakens the dollars that we have in our hands. So we do this thing where we measure the dollar in the dollar index, which is against the euro and the yen. That is absolute nonsense. If you measure the dollar against things things you actually want to buy here. I don't know a lot of people who have side hustles because they want to buy more yen in this country. They want to buy meat and they want to buy eggs. And I know eggs have come off a lot too. But look at beef prices. There are still things that are going through the roof. And because of the weak dollars we have, now there's a lot of different supply nuances to those equations. But I think we should measure the dollar against the top 20 things we buy, which is beef, eggs, butter, beer, bread. In that case, the dollar's weakened unbelievably over the last 3.5 years.
No, 100%. And I think we can all tell a story there, how we go to the grocery store and see prices just skyrocket. I was just at a Whole Foods again. It was like absolutely insane.
Yeah.
Jim, good segue to talk about the Fed. We had the FOMC meeting this week. Maybe we'll start with your main takeaways from the press conference and the announcement. Like, what did you make of it?
Okay, so here I have a thesis that I think I don't share with anybody. I think I'm alone on this. I believe that if it's 2 days before the Fed meeting and the Fed looks at the futures market and the futures market's pricing in almost no chance of an ease, then they cannot ease, because the last thing they want to do is disrupt markets. And I'm saying, even if they thought easing was appropriate, they will just look at the market and say, well, we didn't message that correctly, so the window is closed. We can't ease this time. But what we can do is talk rates down a little bit and say we're going to ease. I think this is all about inflation trending lower. Every one of the data points we've seen recently, PCE, CPI, has trended lower. So I think they're less worried about inflation. I don't think they are massively worried about the economy. I think if they're less worried about inflation, they will probably ease. My base case is they ease once and then I'm 50-50 on the other, despite what they're saying, which, by the way, the Fed is a very, very poor prognosticator of their own behavior, even more than in 2-3 months out. They're not very good at saying what they're going to do. So I think the notion that a transparent Fed is somehow benefits us is absolute nonsense. Yes, markets trade off it and get volatile, but they're not very good at predicting what they're going to do.
No, it's like they're all data dependent, and they're always reacting instead of being proactive. Although,
and I'll add one more thing to
Yeah.
Kai too, is that this Fed, remember, look at Jay Powell, and I've said this a bunch of times. He seems like a hell of a good guy. He seems like his head is in the right place. He's trying to do the best he can for the country. There might be a little bit of defiance of Donald Trump right now, which is a characteristic I like. Don't let be pushed around. But that being said, in late summer of 2021 into fall, they made a tremendous policy mistake. By June of 2021, CPI data was already printing over 5%. The housing market was inarguably on fire. And what did the Fed do? They hit the gas. I think in 20 years, if you ask me about the Jay Powell Fed, I will say it was basically a failure. I don't take no pleasure in that. They seem like they're really trying. I don't see in our country, when you're in a job like that, that's so dependent, I think people should judge it objectively and not say, oh, I don't want to hurt anyone's feelings. I don't care. I mean, they did a bad job, and I think they're worried about doing a bad job again. They're worried about easing too quickly. They're worried about a lot of things, and that sort of trepidation may make for another policy mistake.
Yeah, it's like when you read headlines like Powell says he sees no signs of economy weakening. Like, what do you reply to that? Because obviously, and you see it in the comments below our videos, people are hurting. It just doesn't show up in the headline numbers. Like, what's your reply to that?
I would say that we've seen the biggest K-shaped distribution of wealth and economy and bifurcated economy of the last 5 years of any that I've seen in my lifetime. I think the top 20% of people are driving all the spending. They have the money. The bottom 80% of people, all they have is the higher grocery bills. I think we've done a tremendous disservice and transferred wealth from the middle class to the upper class in the form of assets going higher every time they come up with a dumb policy. The Fed has messed this up. In that respect, I will say our economy's messed up, and we need the lower 80% are hurting, as you said.
Yeah, like one term they're desperately trying to avoid to use is stagflation. Like when I look at the forecasts, like growth forecasts cut from 1.7 to 1.4%, inflation at the end of 2025, 3%, which is obviously higher than now. Isn't that the perfect definition of stagflation? And why are they so scared to use that term?
Right, because it's an ugly term and it scares people of the 70s. But even yesterday, when they came out with their statement at the Fed meeting, and we're recording on Thursday, they said their estimate for inflation ticked up to 3%, and their estimation for growth ticked down to 1.7% from 1.8. That is, like you said, that is the definition of stagflation, where we are seeing higher prices even if the economy is slowing. And I think it's very interesting. Now, what happened in the 70s, it was all about crude oil, and it's not all about crude oil right now. So I don't necessarily agree with the stagflation scenario. I think that that Milton Friedman said that inflation is always and everywhere a monetary phenomenon, and I agree. However, you mix that in with the tremendous supply shocks we saw in 2020 and 2021. That's what really caused the above 5%, above 7% inflation, not necessarily the increased money supply. Now, I think, by the way, the 2% inflation rate is just a note. They got in a room and said, 3% sounds too high, 1% sounds too low. Someone said, how about 2%? So it's kind of an arbitrary figure that they picked. But I think that Jerome Powell, by the way, he would lock in 2.8 for the next 3 years if he had that option, just because he understands that there's so much indebtedness on the federal level. 5 different states, counties across this country have too much debt, and it helps them if we inflate that away a little bit. So I think he'd lock that in if he could.
Yeah, it's interesting because I've been reading mixed signals on that statement you just made there, Jim. Because one of the investors, like I think CNBC quoted that, and I took that from CNBC this morning. But Fed seems willing to sacrifice employment and GDP growth to keep tariff inflation low, investor says. So I'm curious, like, is that the trade-off they're going for? It doesn't sound like, in your opinion, they're doing that.
Yeah, I don't think that is the case. I think that that's just lip service, which, by the way, I'd like to break down the tariffs too. Everybody who, with particularly politically motivated people, the tariffs are inflationary. That is true, but it is massively incomplete. History will show us that when tariffs are implemented, that one, the exporting country oftentimes subsidizes the sector that's exporting. The exporting company sometimes lowers their prices to remain competitive. The importing company who's importing the raw goods lowers their margin. And only then does it get to the consumer after that. And by the way, it's not any sort of persistent embedded inflation expectation sort of thing. It's a one-time price change unless inflations are all over the board. Unfortunately, someone out there is listening going, we have Donald Trump. So the tariffs could easily be all over the board. They could be 2% tomorrow and 20% the next day and 100 the next. And I get that completely. But tariffs, the discussion of tariffs and their inflationary effect is way more complicated than those on the political ends make it out to be.
Yeah, it's an interesting topic. I wanted to ask you about the tariff war and how you see it playing out, because we heard about handshake agreements and agreements with China, between the U.S. and China, of course, but I haven't seen anything concrete. No announcements. It was like a week ago, and now it's quiet. Other topics have taken the headlines. What do you make of that? Are we in the eye of a storm? Like, where are we at?
This is going to shock you, Kai, that sometimes Donald Trump just says things and there might not be as much truth to them. So the market is funny. My sincerest hope at the beginning of this administration was that the markets would be more numb to the volatility-inducing headlines that come out of the president's office. They're not. But I've come to a realization, the big players in these markets, particularly equity markets, I think they like volatility. I think they want tremendous volatility, and they want to react to headlines coming out of the Oval Office. But I will say this, and this is another opinion that I have not found much support for among my economist and analyst friends. I believe that huge bear markets and equities and even very steep corrections are born of complacency and lack of respect for risk. And oftentimes you can see that in options pricing in the VIX, although the VIX is somewhat of an incomplete measure. My point is that if we are dodging punches from the Oval Office on a daily basis, that I actually believe that could make the rally more durable and better. I don't think we're going to new highs until 2026 in equity markets, but I think the longer term, because now we have more respect. Your volatility has obviously been higher this year than most years. I think it is creating more of respect for volatility, more respect for the potential for downward moves in the stock market, and less complacency. How do you like that?
It's an interesting topic. It's like the VIX is at 20 right now, so it seems very Goldilocks, because anything that's been thrown at us, ballistic missiles hitting Israel and Iran, right. And Fed meeting yesterday, and the VIX just didn't react at all over the last few days. It's actually been trending down.
Yeah,
despite
but
all these shocks.
over the year, it's higher than the averages. Which, by the way, can we talk about how the markets reacted to the conflict in Iran? Because I thought it was fascinating. So, because there wasn't any rush to buy treasuries, there wasn't any rush to buy dollars. Maybe for about 10 minutes there was a rush to buy dollars. You can't really say there was a rush to buy gold, although it did probably have a $25 rally read in the initial headlines. But where the market showed up was in oil. So I think the broad market is telling us and I'm not sure that they're right or not. This is my interpretation of their movements, is that the only way this affects the globe is through oil prices. This is not a conflict that is going to broaden out and drag us into some sort of sinkhole or forever war. That's what I think the market's saying. I'm not saying that that's my opinion at all either, although it is my opinion, but that's not relevant here. The market is saying that, which I think is very interesting.
Yeah, it's like I had Linda Alden on the other day, and I keep quoting her because she said, like, well, the US markets are reacting like those of banana republics. Whenever there's a shock, US dollar down, bonds down, gold up.
So,
Right.
okay. And Lynn, by the way, I don't ever like to contradict Lynn because Lynn is brilliant in my opinion, but I think the dollar was trending lower. I was confused about the lack of buying of US Treasuries. So some will say that that's because they've been demoted in their role as safe haven assets in the globe. I'm not ready to believe that yet. And I know I started about talking about watching auctions and watching demand. I still think, Mike Tyson quote, everybody has a plan until they get punched in the face. The global markets have not been punched in the face for several years. And when they are, I do think they will buy the dollar and treasuries, just because aside from gold, is Bitcoin really to step into that role of being a safe haven asset? Not something that moves 30% in a day sometimes. I'm just not ready to believe that yet.
Yeah, and on the day you mentioned, actually, Bitcoin's down 2%, and all the other cryptos were just down 6-7%. I saw on my
So
screen.
there's still a risk
That's
asset.
mostly following, but
Yeah, there's still a risk asset then, in my opinion. And they, again, by the way, the fact that Bitcoin trades as a risk asset, there's a fundamental reason for it too. When big institutions started trading Bitcoin more heavily, they threw it to the NASDAQ people because NASDAQ people were used to the volatility. So oftentimes they were traded off the same desk. So the correlation to those two assets kind of grew together, because if one of them breaks, then you have to, sell what you're making money on to cover the losses on what you're losing money on. So it created a correlation between the two assets. And that's a correlation that hasn't been shaken yet regarding Bitcoin. And I'm watching when it does. And again, I'm a Bitcoin investor. I have been for many, many years. Which, by the way, I'm just a small amount. I'm not ready to buy the villa in Saint-Tropez with my Bitcoin money, but I have Bitcoin, and it belongs in the lack of faith in stewardship of the dollar and broad adoption. As soon as BlackRock started buying it, I started buying it as well.
Yeah. When Lambo, Jim, right? When Lambo.
Lambo. I get it. Okay. I'm not young and hip, but I get some of the references.
No, funny. Jim, before we move on, we got to talk a little more about the US dollar in a second here, but just one last question on tariffs. Like, do you expect more volatility coming out of the tariff wars that we've seen here? I use the term eye of the storm right now. Like, what are your expectations?
Well, Donald Trump, the one thing we can say about him is he understands politics and he understands elections. Now we're 6 months, 7 months into his term right now, and he has another year before a very, very important midterm election. He's starting to hear those footsteps, in my opinion. And I think that we're going to start here tone down tariff wars, and he'll claim victories, and there might be victories, but he'll claim victories whether there is or not. That's just one characteristic we've seen in him for 50 years. But I think that tariffs are going to be talked about less and less, and that is going to be by design, because going into the midterm elections in 2026, he has to portray that things are going well. And I don't know if the media will follow suit. They don't seem to like him very much, but I think that we'll get a lot of agreements in tariffs coming up in the next quarter.
I was going to say, like, we have to show some wins.
He has to show some wins,
right?
No doubt about it. And he'll get some wins. I mean, again, I get, when I'm with pro-Trump people, they think I'm anti-Trump. When I'm with anti-Trump people, they think I'm pro-Trump, which means I'm fine, in my opinion. So I don't have any problem with that. But I do think there's a lot of flaws in the way he negotiates things. But I do think he'll get some wins as well.
Yeah, no, fair enough. And we will definitely monitor it moving forward. You've touched on the US dollar already. We need to take a closer look at it. Like, it has been surprisingly weak, or not surprising, but it's been weaker. Lisa Abramowitz on Bloomberg said the other day, like, it's the biggest trade for her of the year, the fluff leaving the US dollar. Is the US dollar overpriced? Is it too expensive?
No, I actually think that we're going to start to worry about the level that it's gotten to now. When I just was, I went to Europe about 2 months ago, which, by the way, I will say that the euro rallied 13% against the dollar, literally in the 3 weeks before I was going to Italy, making my vacation 30% more expensive. So I'm convinced that the entire market is just lined up to take money out of my pocket. But anyway, the point is that the dollar right now, there's one factor everybody mentions, the flight of capital There's more of a globalization with money going other places, and that's fine and that's true. One thing people don't mention is that for years there was a buy the dollar, sell the rest of the world's currencies trade that needs to unwind that exacerbates this move. So sometimes we look at a move and it gets exaggerated, and it's just based on market positioning, not necessarily this enormous shift in the fundamentals. And sometimes people who don't trade on a daily basis don't really get that nuance, but it matters. And right now, I do still think there's people getting out of that trade. They're selling their dollars to buy back the currencies they were short. But the fundamental change, again, I just don't believe that all of a sudden people are going to say, well, the dollar's awful, let's buy the euro or the yen or the yuan. I just don't see that happening.
No,
There's one other thing I want to mention too, Kai. If there's some Brent Johnson and Luke Groman go into this very deeply about a repatriation that has to happen if if the Eurozone economy is declining, get bad. There's a certain function, and I don't understand it completely, but where they have to repatriate some of their currencies to cover some of their debts at home. That might be why the euro's rallying a little bit too. But again, I think it's more of a market positioning thing.
Yeah, it's like also Germany spending a lot of money or promising to spend a lot of money is just treating capital maybe a little better.
Sure.
At home, because we've seen, I think it was Section 899, where President Trump sort of suggests that taxing foreign investors in the U.S. Is a possibility. I don't have all the details, but of course that is scaring investors.
Well, of course, and as well it should. It should scare investors, and it could be part of the flee and the repatriation or whatever you want to call it, depending on where your perspective is. But that could be part of it as well. But I think the dollar index below 99, below 98 will start to worry people, including the president probably, although he shouldn't have control over the U.S. currency, but he does exert a lot of influence on the Fed, and perhaps he's going to be appointing a new Fed chair. But I think we're going to start to institute policies that may protect the dollar a little bit more over the next 6 months than we did the last.
Yes, like they do. One of the declared goals is obviously a weaker dollar to increase the export revenues, of course.
Be careful what you wish for. Right?
Exactly, right? But has it come too soon? Has it come too quickly?
I think it has. I think it's been exacerbated by the fundamental factors that we just and the market position factors that we said. I think that is too sharp a move. Remember that the dollar, like you said, a strong dollar is great because exports are cheap. A weak dollar can be great because our exports become cheaper and more in demand. So there's not really one position you want of your currency. But when it gets to the extremes, and the question becomes, where is it extreme? I think 95, let's say. Again, that's just a thumbnail, but I think that will worry people in the dollar index again. And Europeans don't even want that too. They want us coming to their country and spending money too. And if the euro goes to 125, less people will do that because they can't afford that vacation. We're not seeing that yet. And we talked about the 20% that still has tons of money. People in the US with the top 20% are still flush and they're spending money, but that could come to a crash pretty quickly.
No, especially when the stock market starts to move and people get nervous and they don't feel as rich on paper anymore.
By the way, Kai too. And by the way, remember, a lot of the rich that people feel is about the real estate market over the last 3 or 4 years too. And the statistics on that, we just had Melody Wright on our show, The Futures Edge, and she laid out an amazing and compelling argument for the real estate market rolling over. I'm not sure I'm 100% on board yet, but I listened to every word she said. Inventories are increasing all over. And if people aren't making their money and they're at people, there is a real thing. It's called the wealth effect. And when your home doubles in value, you probably feel pretty good about spending money.
Yeah, 100%, because you got it backed up by something. Yeah. Right.
Yeah.
No, fantastic. Jim, I think we went through almost all the asset classes. The last one we haven't really talked about, of course, is gold and precious metals. Let's talk gold market dynamics. Like what is happening in gold right now? It's fairly flat the last few trading days.
Last few trading days, again, it has had a Herculean run over the last few years. So for it to be flat a couple trading days, even a couple trading months would not worry me and not shake me from the fundamental story. As you know, I've been beating the drum for gold for approximately 4 or 5 years when I gave the first speech at the New Orleans Investment Conference about the case for gold and why I was going to make it use a massive part of my portfolio. And it's my biggest holding and it's done quite well. I hedge it sometimes well. But when it really accelerated to me was the moment that the Fed, and this was in 2022, the Fed froze Russia out of the SWIFT payment system and froze up all their dollar-denominated assets. Now, this is not a political commentary. There are people out there who are like, well, we should do that. Russia was the aggressor in this war. I don't care. This is about policy. And if you are the steward of the world's reserve currency and the arbiter of global trade, and then you make these decisions favoring one country of another, it erodes trust, and there is mistrust. And we talked about, I don't know if that was before we came on or not, in 2020, 71% of the globe's reserves were held in the dollar and US Treasuries. Even in 2016, that number was like 64, 65%. It has plummeted to 57%. And much of that happened in 2022 when we did that. So again, not a commentary on policy, but if we're going to be heavy-handed in our treatment of people who are using the dollar for trade, it is perfectly reasonable to assume that they're going to move away from it. And they have moved away from it. So now they're only 57% in dollars. And what's been the beneficiary of that? The euro, some other currencies, gold. Yes, they're buying the last 3 years. The global central banks have bought more gold than they've bought in 75 years. And that trend doesn't seem to be reversing. And that was one of the main tailwinds for me getting in, was them diversifying out of that. And this is not a de-dollarization, the dollar's going to hell. That's dramatic and hyperbole. And our job for buying gold as traders and investors is not necessarily to predict that the dollar's going to hell. It's to predict other people are starting to mistrust the dollar and they will buy gold. So we're in that trade and we like it.
Yeah, no, gold is now the second most valuable reserve asset, just behind the US dollar, of course, and ahead of the euro. What do you make of that? I'm sort of summarizing what you just said, but my point is actually like,
there's just something that's funny that jumped out. Again, Warren Buffett is one of the greatest. I have nothing but respect for him. But even the smartest people in the world say dumb things. And one time he said the amount of gold, mined and unmined, could only like fill up like 2 or 3 Olympic-sized swimming pools. There's not enough for it to be the reserve. And I was thinking to myself, if it's trading $1 million an ounce, it would certainly be enough to be the world's reserve. So it's just about the price. I think that he may have even misspoke. It's such a dumb thing to say. But yes, gold has become way, way more important. And again, it's all kind of a shell game. Is the dollar as trustworthy? No, but it's still pretty trustworthy. But it's not as trustworthy it was. So that has to show up someplace else. Has it shown up in Bitcoin? We already established that that's more of a risk asset. Has it shown up in US Treasuries? Yeah, but there is still some questions about that. The one thing there remains no questions about is gold. Now, I think something really interesting happened over the last month, let's call it, where all the other metals, including the other precious like silver and even platinum, hadn't moved at all. The gold to silver ratio had blown out to about a high of 105, and that's historical average is like 55. But let's throw that out. The average over the last since 2017 has been around 80 or 90. Even if that comes back in line, it suggests like $45 silver, and silver is probably my second biggest holding because of that. Platinum I have as well.
No, so I was just going to ask you, like, about silver catching up here. Like, gold silver ratio is down to 91. Is that more of a function of gold coming down, silver revaluing, of course? Like, we're seeing it close to 37, or actually, as we were speaking, 36.25 roughly. It's come down a little bit the last 24 hours. But is silver finally breaking out and catching up?
I believe so too. So historically, that's the gold outperforms in times of geopolitical and economic stress. Global, the gold outperforms, and then all of a sudden a switch is flipped, and silver tends to catch up very violently. We're in the midst of that now, and that ratio has come back to levels that are more acceptable. I still expect it to go back to 80, which is kind of, like I said, the historical kind of average around for the last 6 or 7 years, and that would suggest higher prices in silver. But silver was just tracking like so correlated with copper over the last couple of years, which suggested to me that the market was perfectly comfortable with keeping silver in the industrial metals camp. But then all of a sudden, very quickly, it can flip over to the precious metals camps. Now, keep in mind, central banks are not buying silver. So the reserve asset is gold. They're buying gold. So if central banks did start buying silver, which I'm looking for headlines for that, but so far no go, that could be an additional tailwind. But the tailwind right now is just the catch-up trade to gold, and it's playing out beautifully.
Maybe one very last question on gold move recently.
Sure.
Basel III is coming into effect later in a couple of weeks here. How much of an impact is Basel III revaluing gold or rebranding gold as a tier 1 reserve asset class? How much of an effect is that having?
So I think the market knows those things already. The markets are very, very forward looking. And I think that if that was a tailwind, which probably it is, the question becomes how big a tailwind it is. But I would worry, like if people are looking at gold and saying, well, that's going to be a big deal, gold is going to rally off that. I'll tell you this, we are probably all late in that. So it's probably figured into the price of gold already. And if anything, by the way, in the next, like I said before, gold can have a couple bad months right now, and that's not going to shake me from what I think of it. That being said, now I think it could have a couple bad months right now, and that is just a function of how much it's run up. And, we always talk in the trading world, buy the rumor, sell the fact. So it's like at the Basel, when that gets instituted, we can assume that people have bought the asset that was going to benefit from it ahead of time. And at that point in time, they're looking for a spike to sell out. And it oftentimes has the opposite effect in the market as the fundamental case would suggest. So I think that's more likely than having a big boom off the Basel.
No, fair enough. Really appreciate your opinion on that, Jim. Let's play a round of rapid fire real quick to sum up the conversation. Higher or lower is, those are the two options I'm giving you here. Inflation by the end of the year, higher or lower?
Lower.
Jobless number, higher or lower?
Higher.
S&P 500.
Higher, but not by too much. No, not new highs. Is that too long? And am I only supposed to give one word? I don't think we're going to new highs this year, but right now we're still in a bullish mode, and I think we challenge those highs again.
Okay. Dixie.
The Dixie, the dollar, higher.
Yeah, higher. Gold.
By the way, I was panicking for a second there because I hadn't heard it called the Dixie in a while. I was like, shit, what's the Dixie? Okay, it's just a dollar. We're back. Dollar. We're fine now. Gold, I'm always, what's the time frame again? 6 months, you said, or a year?
Oh, by the end of the year.
I think higher. Yeah.
Silver.
Higher.
Fantastic. Awesome. Jim, really appreciate you joining us. Where can we send our audience to follow your work?
I totally appreciate you having me on. Please follow me at Twitter at Jim Iuorio. Please go to the Unfiltered Investor website. By the way, Mike Arnold and Bobby Icino, who do technical analysis, not just on short term, it's not just for traders. They do long-term technical analysis and portfolio construction as well. And they've had an unbelievable couple months since its launch about 3 months ago.
Phenomenal. Jim, really appreciate you coming on. So good to see you again. We'll have to do this again after the summer.
I love
it. I hope you have a great summer, Jim. Good to see you.
You too, Kai.
And everybody else, thanks so much for tuning in here to Soar Financially. I hope you enjoyed this conversation with Jim Iuorio. If you did, leave a comment, leave a like down below. And of course, if you haven't done so, hit that subscribe button. It's a free way to support us. And I'm really curious to hear your opinions. So put them down below. How do you think we're going to do over the summer? Do you expect more trouble from the tariff front? I do want to hear from you because I read all your comments. Not always healthy, but I read all of them. And I try to take as much in as I can and try to include your comments into our conversations as much as possible. So thanks so much for doing that. And we'll be back with lots more here from Soar Financially. Take care out there.